chairman going to Congress to testify in the economy. Traders, though, telling me they're really not expecting Bernanke to change his tune. Instead, what they are concentrating on is the Federal Reserve's Beige Book survey of business conditions, as that gives you that sneak peek into the economy. But you heard the opening bell. Let's get you caught up. Right now, you have gold down about $16 to $15.73. You're looking at oil basically unchanged at 89. In terms of the major indexes, we have the S&P opening lower, down 0.3%. The NASDAQ down 0.2%, and the Dow Jones Industrial Average down about 47 points. In terms of levels, traders say on the S&P today they're watching 1365 as resistance, 1355.48 as support. Betty.
Josh, thank you very much. And just hang on, because I want to bring in Brian Battle. He's the director at Performance Trust Capital Partners from the CME. And Brian, how do you think the markets are going to trade as we are listening in on Bernanke Day 2?
Yeah, I think it's a headline-driven market, and thankfully, we don't have a lot of headlines. There's no crisis today. So we're going to watch and listen. I think you're right. We're not going to get much out of the Fed, although in the House, it's way more contentious, and they're way more polite in the Senate. So there's going to be a lot more pointed criticism in the House. Might be some headlines there. But the news yesterday was that the Fed sees the economy slowing down, which is echoing what we're hearing for corporations looking forward. They see a deceleration in economic activity that's going to hurt employment, and the Fed is just waiting for it. Perversely, the Fed is waiting for it to get worse to act. So we're not going to get anything out of the Fed in the next 20, 30 days. We'll have to wait until the next meeting.
Hey, Brian, it's Josh. Let's switch to earnings here. You saw Bank of America report this morning, swung to that second quarter profit. Would you be interested in buying the banks here, Brian?
No, I don't think so. You know, there's a couple of different banking markets in the U.S. The big banks are under assault. Their trading revenue is down. Their underwriting revenue is up a little bit for bonds. Mortgage origination is very dependent. Wells is doing great. B of A not so good. The thing that disappointed me about B of A was the quality of their earnings. They're reducing their loan loss reserves. They're firing people. And what they're describing is they're shrinking the bank to fit the amount of capital that they have. It's a long-term process, but it's not healthy long-term. They're not growing revenue. And that's going to be hard because people don't want loans, and trading revenue is declining. So big banks are difficult. I think regional or local banking is a way better trade because their problems are that much smaller.
Hey, Brian, let's talk a little bit more about this earnings season, because we've talked about lowered expectations really playing a role in how many companies are beating those average analyst estimates here. How much of it is a concern for you and your clients that the earnings picture is still robust, but not as robust as it could be if the economy was better?
Yeah, I think it's dangerous. You know, you heard Federal Reserve Chairman Ben Bernanke saying their outlook is for deceleration and no employment. So domestically, that's not good for us. Meanwhile, Europe's burning down, and their biggest trading partner, China, has nobody to sell their stuff to. So on a macroeconomic basis, I think it's very difficult. And I think this is a big distinction. The indices are going to erode. This is going to be a stock picker's market. You can find the jewels, but to buy the S&P and hope it's going higher, or buy the Dow or the NASDAQ, is going to be dangerous because it's going to be individual stars and not the broad market.
Brian, thank you very much. Brian Battle from the CME at Performance Trust Capital Partners. And still ahead, how to play the new earnings reports from Intel and Yahoo, and also what investors should make of Yahoo's new CEO, Marissa Mayer. We're going to talk to a tech strategist, and we'll have much more on Vivus after regulators give the green light to its weight loss pill. The shares are surging. Stay with us. We're back in 2 minutes.
At Merrill Lynch, we understand the importance of your goals. Today, our financial advisors lead from a new position of strength. Together with Bank of America, they have access to more resources than ever before. A steadfast commitment to help you achieve your financial goals in life. That's the power of the right advisor. That's Merrill Lynch.
are about 7 minutes into the trading session right now. All of the 9 major groups on the S&P are lower except for technology. That is the one group that is seeing green as we speak. Now, investors are watching 2 big technology stocks today. I'm talking about Intel and Yahoo. Both are trading on earnings reports that came out after the bell yesterday. Well, joining me now is Bill Wyman. He's the head of technology strategy at ISI Group. And Bill, just an update on the stock. The Intel shares are actually up about 1%. Yahoo is down a little bit, a third row in a day so far. So, Bill, let's tackle Intel first, which is what everyone had focused on yesterday, which is they're taking down of their annual forecast, saying that now the revenue is going to be about 3 to 5% versus the high single digits that they had previously guided Wall Street on. How big of a hit is that? How much is that an indication of demand that we're seeing in the tech sector?
Yeah, so Intel is obviously very important for the whole hardware chain and has pretty broad ramifications. Expectations have been falling fairly sharply into their earnings, and I think what we got is, maybe better than expected. But for me, the real takeaway is we're seeing tech being hit by the global economic slowdown, taking down the Q3 numbers, the full year outlook, slowing hiring. So I think it was better than expected short term, so that's some short-term relief. Yeah. But I think it's a negative precedent for the rest of the tech sector going into earnings now.
Right, and maybe that's why you're seeing the short-term better than expected. Might be why you're seeing the stock up right now. But Bill, what does that mean for, as you say, the overall tech sector? But what about some of the other chip makers are going to be reporting? We've got Qualcomm later today. Would we expect a similar situation with those companies?
Yeah, I think they're going to face a challenging top-line revenue outlook. Perhaps the most disturbing thing for me was the specific commentary that they were seeing the slowdown in economic growth in China impact their business. We know Europe's been in a recessionary environment. We know growth is stalled in the U.S. A lot of hopes on China. That's particularly important in China's case for consumer tech, for PC, handset, semis. So the specific comment that they're seeing a slowdown in demand from emerging markets and from China in particular, I think is going to be a challenge for many of the tech companies, particularly semis, consumer. I think Qualcomm will face these same issues.
Absolutely will hit some of these other technology companies. So, Bill, Intel in particular, though, do they have the wherewithal? Are they able, though, to protect their margins even in the slowdown?
Yeah, so Intel's a very well-run and well-managed company. You saw them slow hiring, slow R&D. They have a structural advantage in terms of CapEx budgets. So I think Intel's in a much better position. We also saw them take share from AMD. So I think Intel is better positioned to weather the slowdown better than many of the other companies in terms of their core business. I think the other thing you have to think about with Intel, and again, this is not just a one-quarter issue, is their growth in tablets and smartphones. Yeah. That doesn't really move the numbers for them yet, but it'll be increasingly important, particularly next year. They're getting design wins around tablets, and particularly the new Windows 8 tablets. So I think going forward, that's going to be a particularly important thing to watch beyond, where are we in terms of the economic cycle.
Bill, just quickly on Yahoo. I mean, we saw those results yesterday. Obviously, the big focus really is on Marissa Mayer, the newly appointed CEO. But the revenue picture is still disappointing at Yahoo. Only underscores how big of a challenge she has.
I think that's right. I think any new CEO will face a very tough time with Yahoo. I mean, revenue growth has been stalled, and bottom line here is you're simply not participating in this kind of secular shift of advertising from offline to online. And they're competing against much bigger and more successful companies, Google, Facebook, and Microsoft. And so I think any new CEO, and of course this is the 5th one in as many years, is going to face just a very tough structural situation. And I think the odds are against them.
But Bill, you say there are still some good assets, right? Some still positives there at Yahoo. Tell me what they are.
Right. So Yahoo still has tremendous breadth. They have reach. Advertisers are looking for that. So they're one of the handful of portals where you can get, literally hundreds of millions of eyeballs. So I think that breadth remains an asset for them. They do have strength around particular product areas, particularly communications and email. So they have targeted places like that where they can leverage. So I think in terms of the business, that's what you need to try and figure out how to build on. From more the investor point of view, I think investors in more near term are looking for how do they monetize the Asian assets, in particular Alibaba. There's been some good news on that recently. So I think in terms of the business side, it's the breadth and strength around particular segments. But in terms of from the investor point of view, I think the key catalyst is can they monetize the Asia assets.
Bill, thank you very much. Appreciate it. Bill Wyman of ISI Group. And coming up, a fashion house top Bloomberg Markets ranking of the best performing IPOs. We'll tell you which one after the break. Plus, we will have the latest on some of the early movers, including how Tesla Motors is doing after new questions about its production schedule. Stay in the loop. Buy dresses and handbags. At least that is when it comes to IPOs. The fashion house Michael Kors has the bragging rights as the best performing IPO after its listing in December. The company is #1 in the latest Bloomberg Markets ranking of IPOs. The ranking measures the 90-day performance of companies that raised more than $500 million between September 2008 through the end of last year. Michael Kors stock has soared a whopping 144% its first 90 days of trading. That is a big contrast to Facebook shares, which have slumped about 10% from the offer price since the company went public about 2 months ago. Now, you can read more in the August issue of Bloomberg Markets magazine. And equities right now are pretty much little change as we await Ben Bernanke's second day of testimony on the Hill. Starts at 10 a.m. Josh Lipton has an early check on the group and individual movers from the exchange. Josh?
Yeah, hey there, Betty. 3 quick movers for you this morning. Let's start off with BlackRock, which is slipping into the red here. The world's biggest money manager said second quarter profit fell 11% as slumping markets worldwide eroded fees for overseeing client assets. Also, Betty, check out Tesla, which is dropping here. That's after analysts at Wunderlich cut shares to sell versus buy. They also cut the price target to 28 versus 49. The analysts seeing third quarter production cuts for sales of the Model S. Finally, though, take a look at Tiffany, which is enjoying a pop. Tiffany raised to buy at Goldman Sachs. The near-term outlook might be shaky, but Tiffany's long-term brand franchise remains rock solid. Analysts telling their clients, Betty.
Thank you so much, Josh. Well, another stock we are watching closely is Vivus. Its shares have surged in early trading after winning FDA approval for its new obesity drug. And Dominic Chu has more on this. A big win for this company.
A big win here. Now, Vivus shares are up they were up as much as 20% before the opening bell. Now they're up over around, we'll call it 10% here. The FDA approved its obesity drug Qsymia yesterday. Now, Vivus CEO really comes out and saying that the drug will be introduced in the fourth quarter of 2012. Now, according to analyst estimates, the drug may generate about $1.2 billion in sales in 2016. Now, the decision marks the second medicine cleared to treat obesity, and that's just in the last 3 weeks here. Consumers are going to be able to choose between Qsymia and Belviq, which is a diet drug from Arena Pharmaceuticals and Eisai Pharmaceuticals that was approved back at the end of June. Now, the pills are the first approved ones in the U.S. for obesity in about 13 years. Arena shares, though, a competitor, remember, fell around 7% in early trading. Now they're down around 5%. Analysts at Barclays do expect that these drugs there, the Belviq drug here, could peak at about $1.5 billion in sales for the overall scheme of things here. According to the U.S. Centers for Disease Control and Prevention, the CDC, more than 78 million U.S. adults are obese, and this raises the risk for things like diabetes, heart attacks, stroke, you name it, and the costs. It costs the economy, the U.S. economy, about $147 billion a year in medical expenses and related productivity losses here. Now, according to Barclays, the market for obesity drugs could get to about $6 billion a year, and Vivus is going to have some restrictions to how they sell Qsymia. The drug is very effective, according to some analysts, which means those warnings, so to speak, are going to have that much more weight on the overall picture. So Qsymia, a very big story, especially if you're one of the millions of adults who have a problem with obesity right now.
Right, and it's interesting because you were saying that a drug has not been approved over the last 13 years. It's so hard, number one, to develop a drug that is very effective for treating obesity, but number two, it's very hard to get approved. And so this really is, a big marker, a big moment for a company like this.
It's interesting here because the drugs are a combination of two drugs that are already on the market right now. One of them is a stimulant that helps suppress your appetite. The other drug is an anti-seizure medication. So you combine those together. That's what you have in Qsymia. Now, it was formerly called Qnexa, but the FDA said you can't call it that. There are too many drugs that have some kind of a nex in their name to it, so that's why they changed it to Qsymia. So watch Vivus shares. Certainly a big mover today, Betty.
Okay. All right, Dom. Thank you very much. Well, still ahead, Goldman Sachs CEO Lloyd Blankfein is in D.C. today for a speech at the Economic Club. He's already telling investors in an op-ed to stick with America. We'll have those details next. as Goldman Sachs' CEO Lloyd Blankfein is the top speaker of the Economic Club of Washington. Our chief Washington correspondent Peter Cook will be listening in and joins us for a preview. And Peter, it's interesting why Blankfein is now heading to Washington. What is he trying to achieve?
Well, first of all, Betty, of course, he was invited by the Economic Club to speak. He's going to be questioned by another big name in the business world, the Carlyle Group's David Rubenstein. So we can expect a pretty friendly reception here. This is also, of course, part of Goldman's charm offensive to improve the bank and Blankfein's image. By doing more publicly, it does not hurt that Goldman in recent weeks has been bumped from the bad bank headlines by the problems at J.P. Morgan and Barclays. We haven't heard as much about Goldman. But the company did just report an 11% drop in second quarter earnings, so do not be surprised if Blankfein does get some tougher questions on the company's business prospects, his own outlook for the U.S. economy. And Blankfein is coming here with a message he is bullish on America. In an op-ed in Politico today, Blankfein says, in his view, the U.S. remains as attractive an investment opportunity as ever thanks to its demographics, its growing supplies of domestic energy, its quick response to the financial crisis, and the nimbleness of American companies. These and other strengths, Blankfein writes in that op-ed, make America more than just a safe port in the storm. They make it a compelling place to invest for the long term, but we need to build on our strengths by addressing some pressing short-term challenges. And those challenges, Blankfein says, include making it easier for people to immigrate legally, infrastructure investment, and top of his list, Betty, improving America's fiscal house. He puts in a specific plug for the Simpson-Bowles deficit reduction plan, saying, again, that the contours of that, it's a serious, responsible, bipartisan effort, could improve the long-term fiscal outlook, and embracing it would send the right message to investors and to corporate managers. So some of Lloyd Blankfein's message today, Betty, but you can be sure he's going to get questions on a host of other topics.
Interesting. All right, Peter, thank you very much, and we'll be back in 2 minutes on In the Loop.
This market is screaming that there is no growth, there is no confidence, and so we made a call, which I hate to make, which is for a flat market return between now and the end of the year.
A call he hates to make. Jonathan Golub, the chief U.S. market strategist at UBS, as you just heard, predicting a flat market because it's uninspiring, right? It means this market's going nowhere.
He's also a bull, too, so it kind of, you take note when a guy like Golub says, things are going to be a little muddly type situation there.
But what I find interesting is it's not just the macro picture that is not screaming growth. You start to take a look at all these company narratives, right? We're in the middle of earnings season. Companies from B of A to Intel to Yahoo, we're just not seeing the growth even in the individual sectors.
No.
Really makes you wonder if this is even a stock picker's market anymore, which a lot of people have always said it was.
Well, it's also about managing expectations, right? You talk about this idea that CEOs, when you are that bullish, you're on the hook for that, and you better deliver. When you start to manage those expectations down, it may not necessarily be that bearish a tone, but you got to set yourself up for success. One thing that a lot of CEOs will be doing throughout the course of this earnings season.
Well, and as we've been hearing so much is that we're looking at the guidance, at the revenue guidance coming out from these companies and these CEOs. And with Intel, for instance, we just, we got something that was quite disappointing. As Bill Wyman was saying, that seemed to be one of the most, actually what was most disturbing to him was the guidance on China and the results out of China, that was really disturbing because China is where we're expecting a lot of this demand.
Yeah, very uninspiring, right? I mean, you have the European issues, which is muddling the consumer demand there. Then you have China's slowdown, which is affecting that part of the world. Then even here in the U.S., kind of lackluster.
IBM's results are going to be key this afternoon for the geographic dispersion, yeah.
Dom, Sheila, thank you. And tomorrow, of course, the earnings season continues. Make sure to watch In the Loop as we hear straight from the CEOs themselves, starting with an exclusive interview with Huntington Bancshares' Stephen Steinour and also Southwest Airlines Gary Kelly. Both will be in the loop tomorrow starting at 8 a.m. And we are about a half an hour into the trading session. We've got you covered here on Bloomberg Television. Eric Schatzker and Stephanie Ruhle are here to kick off Market Makers. Take it away, guys.
Betty, we are looking forward to Ben Bernanke's second day of testimony. This time he's going to be talking to members of the House, and we're going to look back at what we learned from yesterday's testimony. Ben Bernanke talking about his toolkit and not really tipping his hand about the next phase of monetary policy. We're going to be talking to Rich Clarida, the Global Strategic Advisor at PIMCO.
And remember, Ben Bernanke's talking to Congress today, so things could get a lot more heated. That all comes up in just a few.
Market Makers starts right now.
Bank of America beats the street. The bank's losing less on real estate, and CEO Brian Moynihan takes aim at expenses. Ben Bernanke, day 2. The Fed chairman's outlook on the economy is bleak, but he won't say what the central bank will do next. Lloyd Blankfein's recipe for economic success. First, Congress needs to get its act together.
Live from Bloomberg headquarters in New York, this is Market Makers with Eric Schatzker and Stephanie Ruhle.
It is 10 o'clock here in New York City. I'm Eric Schatzker.
And I'm Stephanie Ruhle, and this is Market Makers.
So we are waiting for Ben Bernanke. He's going to be speaking to members of the House Financial Services Committee in just a few minutes. The Fed chairman has just sat down. This is his second day of testimony in Washington, the semi-annual testimony that he delivers. And he'll be talking about the Fed's dual mandate as he was yesterday, right? Keeping prices low, keeping job growth as high as it possibly can. He offered a fairly dim view of the prospects for the economy and gave us a bit of a hint as to what the Fed might do when it finally undertakes its next step in this unconventional monetary policy.
Well, everybody is waiting for clues out of Ben Bernanke here, but he doesn't really have a button that he can push to really lift the economy and boost things, for the United States. And it's really a situation where Congress needs to take action here, and that's really what Bernanke has been saying. Does he have any bullets left? He might say he does, but doesn't really feel like it. Rates are already really low. Where can you possibly go from here? With the fiscal cliff facing us, are we really going to see businesses step up here and grow? I mean, doesn't feel like
that was the Fed chairman's message to many of the senators yesterday. Guys, it's up to you. Now, what Bernanke has to say is of huge import to Wall Street as well, because the Fed's zero interest rate policy is having a devastating impact on bank earnings. In the case of Bank of America, which reported at 7 o'clock this morning, I want to highlight two themes. Number one, cost controls. This is pretty much the only reason why B of A is making money right now. CEO Brian Moynihan is cutting costs at nothing short of a furious pace. He slashed non-interest expenses by 11% from the first quarter. It works out to some $32 million a day. Pretty remarkable. And he eliminated more than 12,000 jobs in the past year. B of A is already beating its cost-cutting targets and now plans to save $3 billion more for a total of $8 billion by mid-2015. Why? Well, A, B of A was a woefully inefficient company, and B, banking is a lousy business right now. Revenue was the lowest in 4 quarters and came in almost $500 million shy of estimates. And while credit quality is improving, that's a good sign, the Fed's monetary policy is effectively killing these banks. Look at the drop in net interest income and lending margins. Now for the second theme, capital. A huge improvement here. B of A used to be the laughing stock of the street. Its balance sheet was full of holes and way weaker than either Citigroup or JP Morgan. But look what has happened over the past year. B of A, believe it or not, now has a higher Tier 1 common ratio than JP Morgan. The banks also started giving us Basel III numbers, what kind of cushion against losses they'll have under the new capital regime. Now, these are just estimates.
I think that essentially, if you look at the, interestingly enough, since Lehman Brothers, and people would say, oh my goodness, since Lehman Brothers fund rate at 0, QE1, QE2, inflation's been running at about 1.5%. So it's just not there in the record. If you look at the dollar, which we may have a chart on that as well, if you look at the dollar, many people think the dollar has to have collapsed in the last 5 years. In fact, if anything, the dollar is stronger today than it was in September of 2007. And in fact, the dollar's been on a roller coaster. It's gone through periods of strength and weakness, but on average, it's been about flat.
And we can see that right here.
Yeah, there's the chart. Yeah, exactly.
Not to mention staged quite a remarkable recovery. Yeah. Not remarkable. A noteworthy recovery
and
over the last several months.
And in part, that's simply due to the dollar is really being driven today, not just by the Fed, but also by the flight to safety, the flight to quality, what we sometimes call the cleanest dirty shirt in the closet, which is the U.S. financial markets right now. Yeah.
All right, Rich. You're sticking around, so we're going to take a break for just 1 minute, focus on a couple of other things, and we'll be back with Rich Clarida, the Global Strategic Advisor, economics professor at, Global Strategic Advisor at PIMCO, economics professor at Columbia, in just a couple of minutes. But right now we're going to take you straight to the latest market action and a few other things you need to know. Dominic Chu is at the touchscreen. Intel tops our headlines. Tesla, one of 3 stocks you need to watch, and Lloyd Blankfein is today's market maker. Dominic, take it away.
Yeah, Eric, I'm watching what's happening with the markets right now, and as you look towards what we're showing you, I want to kind of give you a picture of the overall scheme of how the markets are setting up ahead of Fed Chairman Ben Bernanke's testimony, because remember, it's all about how markets react during these types of events here. We already know that the prepared remarks are going to be very similar to what we saw yesterday, and for that reason, maybe we're seeing a little bit of activity here overall. This is obviously not a correct one here, but, you know, the Treasury side of the equation, we are also not seeing that correct as well. But overall, what we're looking at here is stocks marginally lower. Now, remember what we did see yesterday. We saw a dip when we saw the reaction to the Fed, and then all of a sudden towards the afternoon, we saw those particular stocks start to move a little bit higher. It was all about a momentum trade. Again, in the middle of the day when Ben Bernanke was testifying, stocks weakened and then finished the day stronger. That's something you're going to be watching for sure. Also, watch what's happening, because Rich Clarida was talking about it, about what's happening with the dollar, especially its relationship to the euro. A lot of traders, a lot of analysts out there saying that the dollar is still a currency that you want to buy on weakness here. Depending on what Ben Bernanke says today, that could change. So that's a dynamic you're going to watch as well. Of course, we're watching treasuries with yields at 1.48% right now. That's something you certainly have to pay attention to as well, Eric. So again, lots to keep an eye on in addition to all those earnings we have after the bell today, like American Express, IBM, eBay, and Yum Brands, Eric.
That's true, Dominic. And if Ben Bernanke is going to be making news, it has yet to come. That brings us to Bloomberg's top headlines at this hour. Here's Sarah Eisen.
Well, speaking of earnings, Eric, the world's largest computer chip maker has scaled back its annual forecast. We're talking about Intel, saying revenue will rise 3 to 5% this year now. Personal computer demand has failed to rebound in the U.S. and Europe. Shares of Intel are lower in early trading. The futures broker, who's been dubbed the Midwest Madoff, will ask a federal judge for bail today. The FBI says Russell Wassendorf has admitted stealing at least...
Welcome back, everyone. This morning's market maker is Goldman Sachs CEO Lloyd Blankfein. In an opinion piece on the website Politico, Blankfein gives a big wet kiss to the U.S. of A. He writes that America still has some major competitive advantages over the rest of the world and remains a compelling place to invest. Still, he says, Congress could do 4 things to make it even more attractive. Make progress on deficit reduction. Make it easier for people to legally immigrate to the United States. Invest in infrastructure and compromise for the sake of stability and progress. Later today, Blankfein will be speaking to the Economic Club of Washington. You can watch that speech live beginning at 12:30 Eastern Time right here on Bloomberg Television. Rich Clarida is still with us. He's the Global Strategic Advisor at PIMCO, also an economics professor at Columbia University. So, Rich, Lloyd Blankfein's recommendations are kind of what you hear from a lot of other people.
Yeah.
Would they make a difference here in America?
Oh, absolutely. I think they're all sensible, and I think in particular the issue about really the revolution in energy over a 5 to 10 year period is potentially dramatic in terms of our imports and the competitiveness of U.S. Manufacturing. So, you know, over time, that's a real success story. Obviously, the U.S. has a lot of assets in the private economy. You know, as wages in Asia grow up, you could actually at the margin see some manufacturing relocating here. The real challenge for the U.S. isn't the economy or the vitality of our people. It's really the policy gridlock in Washington, which is we've sort of been numbed by it, but it's profoundly depressing. And you heard the chairman commenting on this yesterday. I mean, fundamentally, this is a fiscal challenge right now, and it's incumbent on Washington to reach a durable agreement.
Rich, thank you very much for being here on Market Makers. We always love it when you come by, and we hope to see you soon.
Yeah.
That is Rich Clarida, everybody, Global Strategic Advisor at PIMCO, Economics Professor at Columbia. We have more coming up here on Market Makers. Fed Chairman Ben Bernanke back on Capitol Hill testifying before a House committee.
What the Fed bill would do would be to eliminate the exemption for monetary policy deliberations and decisions from the GAO audit. So in effect, what it would do is allow Congress, for example, to ask the GAO to audit a decision taken by the Fed about interest rates, for example. Now, that is very concerning because there's a lot of evidence that an independent central bank that makes decisions based strictly on economic considerations and not based on political pressure will deliver lower inflation and better economic results in the longer term. So, again, I want to agree with the basic premise that the Federal Reserve should be thoroughly transparent, thoroughly accountable. I will work with everyone here to make sure that that's the case. But I do feel it's a mistake to eliminate the exemption for monetary policy and deliberations, which would effectively, at least to some extent, create a political influence or political dampening effect on the Federal Reserve's policy decisions. Thank you, Mr. Chairman.
Thank you. I'll note that that bill did not come before the Financial Services Committee, which surprised me. Throughout your tenure as chairman, you've warned this committee and others about the dangers of the U.S. fiscal position, the annual deficit, and the growing national debt. And now we're facing what you called correctly a physical cliff next January. I mentioned in my opening statement the need for long-term restructuring of our entitlements, and as the ranking member said, I was talking about Medicaid, Medicare, and to a lesser extent Social Security. Would you tell us why you're concerned about the physical cliff, what will happen to the economy if we don't do anything to address it, and what long-term strategies Congress should be thinking about as we address these issues?
Certainly, thank you. First, I think there's very little disagreement that the U.S. Fiscal situation is not sustainable. Under current law, deficits will continue to grow, interest will continue to accumulate, and ultimately we will simply not be able to pay our bills. So it's very important over the long term to make decisions collectively about tax and spending policies that will bring our fiscal situation into a more sustainable configuration. Now that, I should add, is very much a long-run proposition. Many of the issues that affect our long-term fiscal sustainability are decades rather than months or quarters in the future. And therefore, I think I would just suggest, if I might, that in looking at these issues, you might want to go beyond the 10-year window, which is usually the basis for fiscal decisions, and at least consider implications of actions for even longer horizons. So it is very important for fiscal stability, for financial stability, for Congress to provide a credible plan for stabilizing our long-term fiscal situation as soon as possible. That's a long-run proposition, however, and the way the current law is set up, we are going to have a very, very sharp contraction in the fiscal situation, increased taxes and cuts in spending that are very dramatic and that occur almost simultaneously on January 1st of 2013. As I discussed in my remarks, and as the CBO has documented in some detail, if that all happens, that will no doubt do serious damage to the recovery and probably would cost a significant number of jobs. It's not essential to do it that way. I think the best way to address this is to attack the long-run fiscal sustainability issue seriously and credibly, but to do it in a more gradual way that doesn't have such negative effects on the recovery. And I think both of those goals can be met simultaneously, recognizing that it's not politically easy, but I believe that's the correct broad approach for addressing our fiscal situation.
Thank you. Ranking member is recognized for 5 minutes for questions.
Mr. Chairman, you say on page 6, we should address the fiscal challenges in a way that takes into account both the need for long-range sustainability and the fragility of the recovery. There are some in the Congress who have been arguing that it's very important in the appropriations we are now voting on for the fiscal year that begins in a couple of months that we substantially reduce what we're committed to spend. Is that what you're warning us against when you talk about the fragility of the recovery? Is it the timing issue that we should not be trying to do this in the immediate next fiscal year, but put into place a longer-term situation?
I'm talking about the collective impact of the tax increases and the spending cuts, which together comes something close to 5% of GDP, which, if it all hit at the same time, would be very negative for growth. It is important to combine a more gradual approach with, of course, a longer-term plan to address sustainability. Let
me ask you, you have been doing a great deal with your colleagues to try to provide an impetus to economic growth, at least an offset to the headwinds, I think would be the way to put it. A number of people from the beginning of your efforts to do this, quantitative easing and the twist and all the other ways that you've been trying to make more money available, have warned that you were risking inflation, and some have said that this might worsen our fiscal condition because you might be losing money. You're aware of the criticisms. This many, I don't know, a couple of years into this, what's the record? Were you wrong?
No, we're not wrong. I have a collection of op-eds and editorials from 2008 and 2009 about immediate hyperinflation, which is right around the corner, collapse of the dollar, those sorts of things. None of that has happened. None of that is going to happen. The Federal Reserve is responsibly using monetary policy to try to support the recovery. We are very cognizant of our responsibility for price stability, and we have the tools to withdraw the policy stimulus at the appropriate time. But markets, for example, as reflected in interest rates and in inflation-adjusted Treasury securities, suggest that markets are quite confident that inflation is remaining low.
I will share with you an insight that I'm sure you have already figured out for yourself, but being able to say, I told you so, is one of the few pleasures that improves with age. And you are certainly entitled to do that with the people who were calling wolf. Part of the problem, though, was that it was ideologically motivated, some of this criticism. That is, there are people, and we have legislation that's been introduced, they're holding it off till after the election because they don't want to, I think, be seen supporting it too popularly, but people will advance it if they can, which would cut in half your dual mandate. You are mandated by the law under which you appear today to be equally concerned about price stability and employment. And there are some who argue that that's inconsistent and that you have, in fact, been distracted from your focus on price stability by this equal mandate on employment. And I believe, by the way, that's part of what people are trying to get at with the audit, because, as you say, we have put into the law already auditing of all your financial transactions, any activity you have with a private company will sometimes be public. I believe this is part of an effort to undermine the dual mandate indirectly. They'll try to do it directly if they can later. Have you found any inconsistency between the two parts of the mandate? Has the concern for employment, which I admire you for showing, interfered with your ability to bring about price stability?
Well, as you say, as you noted, inflation is low. It's in fact a little bit below our 2% target, so there has not been an evident inconsistency, and I think the dual mandate has served us well, and that we do have the ability to address both sides. That being said, of course, we'll do whatever Congress tells us to do.
But have you found any inconsistency in meeting both aspects of the dual mandate?
Generally speaking, no. In particular, low inflation does contribute to healthy employment in the longer term, so they're complementary in that respect.
And your efforts to help the economy overcome the headwinds has not led to any inflation?
No.
Another argument we've seen is that it's regulation that's slowing things down. You talked about the headwinds. I noticed you did not mention the committee meeting you're about to go to was one of those headwinds. Having talked to us about the headwinds, in your judgment, the financial reform legislation that we passed, is that one of the headwinds?
Well, I wouldn't want to rule out regulatory and tax factors as part of the uncertainty. There's a lot of uncertainties.
I don't mean in theory. I mean the one that we have adopted.
Well, it's possible that some of these regulations have some impact on the cost of credit, but there have been a lot of analysis that suggests that the benefits in terms of reducing the risk of a financial crisis are extremely large, and that whatever costs are involved are worthwhile.
Well, I thank you. I hope with that analysis from our bipartisan appointee here that some of my colleagues who preach the virtues of benefit cost analysis will not ignore its benefits as you have just mentioned them. Thank you, Mr. Chairman.
Thank you, Dr. Paul, for 5 minutes. I'm sorry.
Yeah, thank you, Mr. Chairman. I had a question prepared, but I think I better follow up on the question you asked, Chairman Bernanke, dealing with the audit of the Fed. Because when the Fed talks about independence, what they're really talking about is secrecy, not transparency. And it's the secrecy that I don't like and that we have a right to know about. What the GAO cannot audit, and I believe it would be the position of the chairman, is it cannot audit monetary policy, and you expressed yourself on monetary policy, but it would not be able to look at agreements and operations with foreign central banks and governments and other banks, or transactions made under direction of the FOMC, discussions or communications between the board and the Federal Reserve System related to all those items. So it really... It's really not an audit without this. It's still secrecy. And why this is important is because of what happened 4 years ago. It's estimated that the amount of money that went in and out of the Fed for the bailing out overseas was $15 trillion. Well, how did we ever get into this situation where Congress has nothing to say about trillions and trillions of dollars of bailing out certain banks and governments through these currency swaps? And the chairman has publicly announced that he's available. There's a crisis going on in Europe. Part of this dollar crisis going on that's been building. It's unique to the history of the world in monetary policy. And we stand ready. Who stands ready? The American taxpayer, because we're just going to print up the money. As long as they take our dollars, we'll print the money and we'll bail them all out, and we're going to destroy the middle class. The middle class is shrinking. The banks get richer. The middle class gets shrink. They lose their houses. They lose their mortgages. This system is biased against the middle class and the poor. So I would say that this is, if we protect this amount of secrecy, it is not good policy, and it's not good economics at all, and it's very unfair. But my question is, Mr. Chairman, whose responsibility is it under the Constitution to manage money? Welfare expands exponentially, wars never end, and deficits don't matter. And when it comes to cutting spending, Republicans and Democrats to get together and say, oh no, we can't really cut. And if we do cut, we just cut proposed increases.
Mr. Chairman, regular order.
You stand there, you stand
regular order, Mr. Chairman.
And facilitate it all.
Thank you, Dr. Paul. Congressman Clay for 5 minutes.
Thank you. Well, can we get the answer in writing to that question, Mr. Chairman?
May I just comment, Congressman Paul, your objections are to the structure, the system, as you mentioned, but all of the actions we took during the crisis, the swaps, all of those things are fully disclosed. It's not a question of information. It's a question of whether or not you want to give the Fed those powers. If you don't want to, of course, Congress has the right to take them back.
Thank you. Will the gentleman yield me 10 seconds?
I yield to the...
Just to mention that, in fact, in the financial reform bill, I think unanimously, while there were some differences, we repealed Section 13.3 of the Federal Reserve Act, which was the single biggest grant of power to the Federal Reserve to lend money anywhere it wanted if it thought there was a chance to do it. It was the AIG loan. So, in fact, this Congress in 2010 made a substantial reduction in the Federal Reserve's authority.
Mr. Chairman Bernanke, the national unemployment rate is 8.2%, lower than it was a year ago. And as I said, it's important to put all Americans back to work. But I'm troubled by the large disparity between the unemployment rate of the country at large and African Americans, which is at 8.2% versus 14.2%. And I think that's a national crisis. Mr. Chairman, what do you believe this large difference can be attributed to?
Well, it is a tragedy and a problem, of course. It's a long-standing difference. I don't know how to parse the difference. Some of it is educational and other differences. Some of it is discrimination. It's hard to say how much. Age and other demographic factors play a role. Unfortunately, this is not something monetary policy can do much about. We can only hope to address the overall state of the labor market and hope that a rising tide will lift all ships, so to speak. But clearly, African Americans remain disadvantaged in education, in wealth creation, in opportunity, and those are issues that collectively I hope we can address.
Do you think there's anything that the Federal Reserve, along with Congress, can do to address it?
Well, again, the Federal Reserve's monetary policies are limited. We have a variety of things that bear on this indirectly, such as our Office of Minority Women Inclusion, which tries to help ensure that in our own employment that we have full diversity, financial literacy programs that try to help people in lower and moderate income communities achieve a better level of savings and wealth. But more broadly, I think to really address these questions, issues of mobility and education, skills, etc., are more a function of congressional and state and local efforts than the Federal Reserve.
Thank you for your response. Can the Federal Reserve institute a monetary policy that is strong enough to avoid a double-dip recession?
Well, at this point, we don't see a double-dip recession. We see continued moderate growth, but we are very committed to ensuring, or at least doing all we can to ensure, that we continue to make progress on the employment side, and we have stated that we're prepared to take action as needed to try to make sure that we see continued progress on employment.
In another area of the economy, how will the Federal Reserve's expansion of asset rates for stimulating the economy succeed when many individuals have liquid assets that may lose value?
So you're talking about various monetary policies of the FOMC? Our monetary policies actually generally increase asset values, broadly speaking. There is, the concern has been raised, and I fully understand it and sympathize with it, that low interest rates penalize people who live off the interest earnings of their investments or their savings. And again, I fully appreciate that concern. My response, at least in part, is that if we're going to have good returns on savings and investment overall, we need a healthy economy. And if we raise interest rates prematurely and cause the economy to go into recession, that's not going to be an environment where people can make a good return on their retirement funds or their other investments.
If the U.S. were to announce it was moving to a gold standard, what would you expect to happen to the price of gold, and how difficult would that make it for the country to fix the value of currency in terms of the price of gold?
Well, that's a very complex question. I think there is an issue about whether, at least at current prices, whether there would be enough gold to set up a global gold standard. But there are more fundamental issues with the gold standard than that, which I've addressed on other occasions. And in particular, a gold standard doesn't imply stability in the prices of the goods and services that people buy every day. It implies a stability in the price of gold itself.
Thank you for your response.
Thank you. Let me advise the Republicans on the committee that Mr. Hensarling and Mr. Jones, because of the questioning lineup, go first, and then under the Greenspan rules, Mr. Manzullo and Mr. Fincher, if they're here, and then we'll resume with Mr. Royce. So at this time, I recognize Mr. Hensarling, the Vice Chair.
Thank you, Mr. Chairman. Good morning, Chairman Bernanke. You're clearly here before us because of your dual mandate. And speaking of maximizing employment, clearly the Fed took a number of dramatic actions in 2008, some of which I considered proper, some of which I still question. But 2008 was 4 years ago. I think it is an inescapable conclusion. We have now seen the greatest monetary and fiscal stimulus thrown at an economy in our history. And what do we see but 41 months of 8% plus unemployment, 14.9% real unemployment if we look at those who have left the labor force and those who are seeking full-time employment. We have a need of what it should be by historic standards, and my interpretation of your testimony is you are predicting much of